All right, let's talk about Whirlpool. 2024 was a really pivotal year for them. This is a story about a company that's been around for over 110 years, making a massive bet by intentionally shrinking itself to get ready for future growth. So let's break down exactly how and why they did it.
This is really the big question here. For a company as established as Whirlpool, reinvention isn't just a buzzword, it's a monumental task. And in 2024, they decided to tackle that challenge head-on, making a huge bet on their future by letting go of a pretty significant piece of their past.
So, before we jump into the big strategic shifts, let's just get a sense of how big this company actually is. Understanding their scale is, well, it's pretty key to grasping why the moves they're making are such a big deal. Now take a look at this regional breakdown, because this is really interesting. A massive 62% of their sales are from North America alone. Tack on another 21% from Latin America, and wow, the Americas are, without a doubt, the heart of their business. Now, keep that little 5% slice for Europe in the back of your mind. It might seem small, but it is right at the center of this whole story. And just to put their size into perspective, check out this number. $16.6 billion in annual sales for 2024. So, you can imagine, when a company this size decides to change direction, it's not just a little course correction. It's like turning an aircraft carrier. It has massive implications. And that brings us right to the core of Whirlpool's 2024 strategy, this major portfolio pivot. This wasn't something that just happened. It was a very deliberate, very strategic decision to completely reshape the company's global footprint. So you might be asking, why make such a drastic move? Well, the CEO, Mark Bitzer, he put it pretty plainly. This quote here says it all. For 30 years, 3 decades, their European business just wasn't making them money or creating value. So after all that time, they decided it was time to cut it loose. This really breaks down the whole before and after of that decision nice and clearly. On the left, you've got the old Whirlpool, bogged down by this low-margin European business. And on the right, a much leaner company, totally laser-focused on the higher-margin Americas, which now, by the way, make up almost 90% of their revenue. So what's left is what they're calling their powerhouse portfolio. And when you look at the stats, you can see why. They're number 1 in the market in both North and Latin America. They've got the number 3 spot in India, the fastest-growing market in the world. And they have the top mixer brand globally. The new portfolio is clearly built on being the leader. Okay, so a major strategic shift like this doesn't happen in a bubble, right? Let's dive into the financials for 2024 and see how this new strategy, mixed with a pretty tough market, actually showed up on the bottom line. As you can see pretty clearly here, annual revenue has been on a downward slide for the past 4 years. It's gone from $22 billion back in 2021 all the way down to $16.6 billion in 2024. Now sure, part of that drop is because they sold off the European business, but there's another major factor at play. And we see the exact same story when we look at profitability. This chart shows ongoing EBIT, which is a really key way to measure a company's core operational profit. And yep, it's followed that same downward path, from $2.4 billion down to under $1 billion in 2024. So what's really going on here? The company points to one main culprit, a really sluggish housing market in North America. We're talking existing home sales at a 30-year low, and that has a direct domino effect. I mean, think about it. When people aren't moving, they aren't buying new refrigerators, washers, and dryers. It's really as simple as that. But here's where it gets nuanced, and this is super important. While the big picture was tough, the problem wasn't everywhere. This table shows that the issue was almost entirely contained in North America. Look at this. Latin America, Asia, and small appliances all had solid to strong sales growth. They were actually doing really well. So what do you do in a tough year when your revenue is down and your main market is in a slump? Well, for Whirlpool, the answer was to double down on their capital allocation plans and focus on giving value directly back to their investors. First up, their top priority was getting cash back to shareholders. They paid out roughly $400 million in dividends.
And they supplemented that with about $50 million in share buybacks.
But maybe the most crucial move for their long-term health was this. They got serious about strengthening their balance sheet. They paid down $500 million in debt. That's all about building a more resilient company for whatever comes next. And what comes next brings us to the future. Let's talk about the massive, long-term bet that is underpinning this entire strategic pivot. It's the real reason they've gone all in on the Americas. The CEO lays it all out right here.
They are convinced the current housing slump is just temporary. They see a fundamental structural undersupply of housing in the U.S. that will eventually lead to a multi-year housing boom. And their argument is, when that happens, who is better positioned to benefit than Whirlpool, a company now almost entirely focused on the Americas?
And the data behind that huge bet is this number right here, an estimated shortage of 3 to 4 million housing units in the U.S. The company's logic is pretty straightforward. Sooner or later, those homes have to get built, and every single one of them is going to need a kitchen and a laundry room packed with new appliances.
So that's what it all comes down to, right? Whirlpool has made its play. It's shed its low-margin European business to focus all of its energy and resources on the Americas, betting everything on a big housing market recovery. Is this a genius move of strategic foresight, or is it a massive gamble on a future that might not play out? I guess only time will tell.